Hello to all investors, great to see you. In today's video, we will do the top 30 quotes from one of the greatest investors of our time, the late Mr. Philip Fisher. If we miss any quote you like, we do apologize, and please share it with us in the comment below. Thank you. We will take a quick moment to introduce Mr. Philip Fisher to those that don't know him. He is an American investor with a net worth of $4.3 billion and the author of The Common Stocks and the Uncommon Profits, where he introduced the scuttlebutt approach technique to the investment world. This technique was used by Mr. Warren Buffett many times during his investment career. Please, if you have a chance, pick up Mr. Fisher's book. Even Mr. Warren Buffett said that this book is a very, very good book. We will leave the description below. With all due respect and no further delay, let us dive into Mr. Philip Fisher's top quotes. 1. The successful investor is usually an individual who is inherently interested in business problems. 2. Usually a very long list of securities is not a sign of the brilliant investor, but of one who is unsure of himself. 3. Conservative investors sleep well. 4. If the job has been correctly done when a common stock is purchased, the time to sell it is almost never. 5. Investors have been so oversold on diversification that fear of having too many eggs in one basket has caused them to put far too little into companies they thoroughly know and far too much in others which they know nothing about. 6. The need for patience if big profits are to be made from investment. 7. The wise investor can profit if he can think independently of the crowd and reach the rich answer when the majority of financial opinion is leaning the other way. 8. This matter of training oneself not to go with the crowd, but to be able to zig when the crowd zags, in my opinion, is one of the most important fundamentals of investment success. 9. If you can't do a thing better than others are doing it, don't do it at all. 10. There is a complicating factor that makes the handling of investment mistakes more difficult. This is the ego in each of us.
Before we move to quote 11, please, if you like what you see so far, may you kindly click like and subscribe. This will really help us a lot, and we truly owe it all to you. Thank you.
11. He should take extreme care to own not the most, but the best. 12. I believe that the greatest long-range investment profits are never obtained by investing in marginal companies. 13. Investors had best stay away from low profit margin or marginal companies. 14. It is not the profit margins of the past, but those of the future that are basically important to the investor. 15. If the right stocks are bought and held long enough, they will always produce some profit. However, to produce close to the maximum profit, some consideration must be given to timing. 16. Forecasting is like trying to turn lead into gold. 17. If we have made a mistake in buying a stock, but can sell the stock at a small profit, we have somehow lost any sense of having been foolish. On the other hand, if we sell at a small loss, we are quite unhappy about the whole matter. 18. An investor should always realize that some mistakes are going to be made. 19. Go to 5 companies in an industry, ask each of them intelligent questions about the points of strength and weakness of the other 4, and 9 times out of 10 is surprisingly detailed and accurate. 20. Buying a company without having sufficient knowledge of it may be even more dangerous than having inadequate diversification. Just a quick friendly reminder from payingforward.net: if you do well in life, or when you do well in life, seek ways to pay it forward to others that are less fortunate than us. Thank you. 21. The bigger a company is, the harder it is to manage efficiently. 22. An investor should never sell out of an outstanding situation because of the possibility that an ordinary bear market may be about to occur. If the company is really a right one, the next bull market should see the stock making a new peak well above those so far attained. How is the investor to know when to buy back? 23. The more successful the corporation, the more likely it is to be unique in some of its policies. 24. Only by growing better can a company be sure of not growing worse. 25. In the stock market, a good nervous system is even more important than a good head. 26. When a stock has been selling too high because of unrealistic expectations, sooner or later a growing number of stockholders grow tired of waiting. 27. Every time individual stocks take sickening plunges, Another group of badly burned investors places the blame on the system rather than on their own mistakes or those of their advisors. 28. All the correct reasoning in the world is of no benefit in stock investment unless it is turned into specific action. 29. The true investment objective of growth is not just to make gains, but to avoid loss. 30. War is always bearish on money. To sell stock at the threatened or actual outbreak of hostilities, so as to get into cash, is extreme financial lunacy. Actually, just the opposite should be done. If you like to have access to free intrinsic value calculators, please visit our site at valuesnip.com for free intrinsic value calculators. Thank you for making it this far. We throw in 3 important bonus quote here just for you. 31. Finding out which physician had lost the smallest percentage of his practice through death would not be a good way to pick a superb doctor. 32. The investor will do well to exclude from investment any company that withholds or tries to hide bad news. 33. Correctly judging the long-range sales curve of a company is of extreme importance to the investor. Superficial judgment can lead to wrong conclusions.